We talk about all of this and then the wherewithal whether people would be inclined to want to do something like that. They have been spending on dinners out. They have been going to the movies. In fact, it says something about this economy that they have been splurging on a lot of things they have not typically done in the past. Many argue buoyed by the tax cuts, buoyed by just having more optimism about the economic future. Market watcher Ed Mills is with us, Moody's chief capital markets economist John Lonski. John, what do you see of that momentum and the backdrop here, not only for those who want to go to the movies, but for those going out? All these numbers have picked up considerably.
Yeah, I think second quarter growth is going to be very impressive, close to 4%. But I believe that that's unsustainable, mostly because it's been accompanied by a drop in the personal savings rate. So unless we see some surge in employment-related income, we're perhaps going to level off for real consumer spending at a pace just under 3%, which is darn good and should extend the economic expansion, which will be good for payrolls, and it will have positive implications for the November elections as far as the incumbent is concerned.
You know, Ed Mills, one of the things that's been mentioned a lot is the strength of the economy in the quarter we're in. I think the Atlanta Fed had said it could easily be 4.5%, 4.8%. I think the Atlanta Fed has been wrong before on this sort of stuff, but it's obviously convinced it will be stronger than past quarters in quite a while. Do you agree with that?
Yeah, I think that is a base case right now. When you look at the tax cuts, normally after you cut revenues, you cut expenditures. What Congress did is they came up and they did another $400 billion worth of spending that wasn't anticipated for this year and next year. You have 100% depreciation of any CapEx for businesses and a whole bunch of foreign earnings coming back from overseas. So when you do tax cut, repatriation, more fiscal stimulus, that's probably the formula for economic growth, at least in the near term.
So a lot of these companies that have been churning out these great quarterly reports and numbers and a momentum that will be sustained, they say, you know, for the rest of this year, you buy that?
So far, yes. I mean, I think that the big question for me, and part of the reason why I think the stock market is as up as it's been since the 2016 election, is the fiscal stimulus coming out of D.C., as well as the deregulatory agenda. The biggest thing that threatens that is the trade agenda, tariff uncertainty, geopolitical risk. So while we have really good highs right now, the one thing that could hit consumer confidence, what could hit folks in the pocketbook, are some of these trade wars that Trump seems to want to start.
You know, John Lonski, on the trade thing, there's a flip view that's out there in the bullish case that despite the higher prices to come, but because of the slowdown that will likely create, the Federal Reserve is less inclined to hike rates as much. Do you buy that?
Well, you know, we don't want to lose our focus on what's going on in the interest rate front. If we have a situation develop where interest rates take off, that could slow down the economy considerably. You know, I think what we found lately is that we've had these rate hikes. We had the 10-year Treasury yield briefly go above 3%, right. But we had negative responses abroad, especially as far as emerging market countries are concerned. So it might well be that because of a still slack global economy, the upside for Treasury bond yields is limited, and as a result, we might be looking at stronger than expected growth related to credit domestically. That being said, the housing sector is performing miserably in terms of stock price performance. The last time I looked, that's down by more than 10%, 10 to 15% for the year to date, largely because investors are worried about the ability of housing to shoulder this possibility of a prolonged stay by a 10-year yield above 3%.
Yeah, but we would have clawed for those times when we were younger, right?
That's true, but today things are a lot different.
No, you're absolutely right.
As I mentioned earlier, look at that personal savings rate. How can you have inflation take off in a recurring fashion when perhaps 1/3 to 40% of U.S. households have zero savings? When these households see prices move higher, they only have one choice, and that is to cut back on some type of consumer spending, some type of discretionary spending.
Ed, let me raise a wild card development with you. It might be off the wall, but I'm curious what you make of it, and that is that we're all wrong on this building consensus that Republicans are going to lose control of the House. My view is they lose a few seats, but they don't lose the House. They actually add the seats in the Senate. So that is contrarian, I grant you. But how would the markets react to that?
I think it would be positive. One of the jokes in D.C. right now is that Democrats haven't been as confident about an election since the 2016 election. Now, I do think the base case is a Republican majority in the Senate, given where the map is. But I do think the base case is a Democratic majority in the House.
Even now, with everything else, all the improving numbers, everything. So you still see that?
Well, I think a large part of this is going to be based upon kind of enthusiasm among Democratic voters and kind of where some of the seats are. But I think that's a good outcome for the market, and I think the market would also look to a good outcome with the Republican majority. You're looking at the continuation of the deregulatory agenda if the Republicans maintain control of the Senate, because all of the confirmations go through the Senate.
No, I know, but
and we look at more fiscal stimulus.
Or they're in charge of the House, the Democrats. I mean, whether you're on the right or the left, it's going to get ornery with impeachment hearings and the rest. So I would imagine
it's ornery now. I mean,
you're actually right about that. I'm just wondering what you, John, then make very quickly of the possibility Republicans hang on to both houses.
They hang on to both houses, provided that Donald Trump does not shoot himself in the foot regarding these issues concerning international trade. That worries me. You have, some companies right now are perhaps holding back on investment spending. You might be seeing less in terms of very important foreign direct investment. That's overseas companies building production facilities in the United States because of worries about what might become of tariffs. So it's of critical importance that Trump keeps his head about himself as far as what's going on with tariffs and whatnot. And if that's the case, I see the unemployment rate under 3.5% come November, and it would be almost impossible for the Republicans to lose control of both houses.
Well, I'll burn the tape if I'm wrong, but I see them hanging on. But guys, this conversation never happened if it doesn't go my way. I want to thank you both. I hope you have a wonderful weekend.